Hi, this is CA Akshatha Udupa. Welcome you all to my session on basics of stock market. I strongly believe that the people who are watching my particularly this video are those either from non-financial background or you are just beginner in this stock market. So keeping this in mind, I will try to make this session as simple as possible. Stock market is not something which can be understood only by the people who is having a strong financial background or by someone who is a genius. Stock market is as simple as that. It is not a rocket science. Even if you apply your common sense, you can easily understand what is stock market. It's all about mind game. It is all about the sentiments of the market. You need to move as per the sentiment of the market. That is, you have to think like all others think. That's all. If you go on thinking something very complex, you will end up somewhere else. So stock market is as simple as that, and let's make this more interesting and more understandable today. Now, if you are a newbie to this stock market, the first thing that comes to your mind is stock market is gambling. It's not only you, it's even me. When I initially didn't know what is stock market before starting investing in stock market, even I had the same feeling that stock market is gambling and it is not made for people like us. It's only for those who are millionaires, who have the capacity to be in this gambling world. But is that true? Let's just check it out. Now look at this chart that is displayed. What comes to your mind initially when you see this chart? This is nothing but a chart of Nifty 50 index from 2010 to 2021. Now what exactly comes to your mind when you look at this chart? Just give it a thought. Yeah, you can see that this is a simple graph which is moving in the upward direction, right? This is the data of the past 10 years and you can see that the graph is constantly moving in the upward direction. Yeah, in between there are some falls, that is some small movements wherein the graph came down and then again the momentum, it took the momentum and is moving upwards, right? So what can you make out from this? There is nowhere or there is no such place wherein this graph fell down and didn't recover, right? You cannot say someday the stock will fall and it becomes zero, right? That's not possible. The stock market will always move in the upward direction, even though there are small falls in the short term. In the long term, when you see, the stock market is something which will keep on moving. If you observe here, I mean moving upwards. If you observe here in 2010, it was somewhere around 4,500, right? Where is it now? It's nearly 15,000. What a drastic move, right? So in long term, stock market is something which gives you very high return. Again, in the short term, yes, there are chances of incurring losses because of our strategy, because of our lack of knowledge, because of we getting into our emotional situations, okay, wherein we cannot control our mind. We just go on trading without knowing anything, without doing proper analysis, and we end up making loss. That is again a different matter. But in the long run, if you can see, there is no other source which will give you such a good return. If you had invested, if you invest and wait for some 1 year or 2 years, then the return that you get is really more than any other source of income. So this graph will clearly show you how the movement in stock market happens, right? So this same thing applies to different stocks. Now, yeah, the chances are there that if the company closes down or some such extraordinary situations happen, then the share price of a particular company may come down. But when you consider stock market as a whole, it's always something which gives you a very good return, provided you apply your common sense and do your analysis. So to give a quick example on this, if you see Nestle India Limited, this is a company, when it was formed, the face value per share was rupees 10. Okay, now what is face value and all these individual terms in deep I'll explain in the next part of this session. So for the basic understanding, face value is nothing but the value that promoters have paid to get the share. Okay, this rupees 10 is a value or is a price which promoters paid to buy the shares of this company. That is the initial price. That is when the idea of making this company or when the idea of this business came into picture, this was a price which was fixed. That is face value rupees 10. Then this stock was listed, that is this stock was available for trading to public in 2008. When this happened, the price quoted was 1300. Now why this move from 10 rupees to 1300? That is because this face value is a value which promoters, that is people who started this idea, paid to purchase this share, right? Now when the idea is formed, you don't have any guarantee that the company will grow or the company will close, right? So the risk involved is also very much. Because of that, the face value will be at a very minimum price because there will be a lot of risk and you don't know how the company will move. So face value is a value which promoters pay to buy the shares of that company. So listing price will obviously be more than face value because when a stock or when the stock of that company is put to listing, it will already be developed to some extent. Okay. Further, if they want to expand, when they need a fund, the company or the promoters or the investors all come together and they will decide that we'll go for listing. So when listing price comes into picture, it will always be more than the face value. Again, there is a separate process. Okay, it's a valuation process that happens. I'll just explain all that in deep in the next later parts of this session. So you can see in 2008, Nestle India's listing price was 1300. Do you know what is the market value today of this Nestle India Limited? It is 16,100, around 16,100. So in just a span of around 13 years, see what is the increase. Even if you hold around 10 to 15 shares of this company, if you had bought initially, that is at 2008, what is the amount of return that you got in these 13 years, right? Will any banks or will any FDs or will any other investment opportunity will give you this a great return? No. Now to do this, what you need, it's a common sense. You will have to just see which is a company that is getting listed, right? Or who is calling for IPO. What is IPO? I'll come into it later. So you will have to just see what type of company is it, what is the sector in which it is dealing. A few companies like a medicine company or say Britannia, who will not use the product of Britannia, who will not eat biscuits, right? You have to see what type of product is it, you have to see what type of industry, sector in which it is operating, and then you have to smartly decide where you will invest. Again, it will involve some fundamental analysis, which also I'll be covering in the later parts of this session, wherein I'll clearly say you what are the fundamental things. That is, even if you don't know what is balance sheet, even if you don't know what is P&L account, you can analyze the balance sheet and P&L, that is financials, without any knowledge. Okay, how to do that I'll explain in the later parts. So you can see this is just an example to show you how the stock market works, that is how it can be beneficial to you. Moving forward, why all these stock market investments, higher return giving opportunities, all these things are required? Why we need to explore all this? Because we have to save money, right? Now if you keep on saving money without investing it anywhere, what happens? The 100 rupees which you save today will remain 100 rupees only, right? The first thing. Second thing, due to inflation, the cost of everything that you buy, even the necessary items, the cost of the necessary items that you need to buy will increase. The 100 rupees today will not be of same value after 10 years, right? The 100 rupees of today can become somewhere around 50 rupees. It doesn't mean literally it will come to 50 rupees, but I'm telling the value of that 100 rupees will definitely decrease because of inflation, right? So we need to save money, not only save money but grow money in a faster phase. That is, you have to see what is the percentage of inflation that can happen and the same percentage of return you need to get so as to secure your life. So after your retired life, you are free and you are just enjoying your life. That's why savings become important. Now why to invest the saved income in stock market? Because this will give you a high return. It is high riskier, but it will give you high return if you smartly invest in stock market. That is, the return percentage is around 14 to 15% if you smartly invest again, and no other source will give you this good return. If you invest in FDs and all, you will get around 4 to 5% return, not more than that. Now, for your long-term growth, you have to go for stock market. Now, if you are good in technical analysis, then you can go for intraday. That is, you want to earn something today. If you want to earn something in a week or so. But if you're not that good at technical analysis, you can apply your common sense, smartly decide which stock you have to invest and invest it so that in long term you will get a very good return. Now, investing in stock market is medium liquid. What is this liquidity? If you want to take that money back immediately. Now, say I invested money somewhere. Now I need that money immediately. I don't have any other source, and immediately some emergency occurred and I want that money back. Now, is it possible to take that money back immediately? If it is possible to take that money back immediately, then it is called high liquid. If I cannot take that money for a long time, then it is called very low liquid. So this stock market as medium will provide you medium liquidity. That means if you invest and if you want some money, if it for urgent necessity, that is for emergency, then you can take that money from the market. It might take around 1 or 2 days sometimes to get that money in your account. So it is medium liquid. Whereas FDs and all that, the liquidity is very low because it takes time, first thing, to take that money. Again, for premature withdrawal, they will charge some interest. So it is not that liquid. So now let's go in deep of what is this stock market all about. Stock market is nothing but a market wherein the stock is bought or sold. Like any other market, like your vegetable market, right, like your grocery market, this is also a market, but you are dealing with what? You are buying and selling shares. Okay. Now, this market is not in physical form. Now, this is in electronic form. That is, you can sit at your home. Only thing that you need is your laptop and of course your funds and a trading account. With these three requirements being satisfied, you can sit at home and you can trade in stock market. So stock market is a market where shares or stock is bought and sold in electronic form. There are two stock markets right now, that is BSE, that is Bombay Stock Exchange, and NSE, that is National Stock Exchange. Now, wherever we go, wherever there are a lot of things happening, there are a lot of people involved, there are a lot of transactions with huge amount is involved, there has to be someone to control it, right? Now, if some program is happening, there has to be an MC or an anchor, right? Without whom the program will not actually get executed. Similarly, stock market is something which involves millions of capital, which involves a lot of transactions happening, which in fact involves a lot of people, right? So there has to be someone to regulate it. Now, this whole stock market is regulated by SEBI, okay, which is Securities Exchange Board of India. This is a very powerful body which is having a lot of power, which can just flag you up if it finds anything fishy in your transactions. So the whole stock market is regulated by a regulatory body which is called SEBI in India. So it is Securities Exchange Board of India. Now different countries will have different regulatory bodies. In India it is SEBI. Next, these are the basic things which you have to know about what is stock market. Next important thing which we need to know is the financial intermediaries. Who are these financial intermediaries? Now, the stock market is not like we just going to a shop, buying something and coming back. We sit at home and we transact electronically, right? Now, we don't know who are the people involved. We just place our order, we just buy the share, and after some time, if we find profitable, we just sell the share. Now, in between, who is going to buy the share? If we buy the shares, who is going to sell it to us? Or if we are selling the shares, who is going to buy our shares? In between, what happens? How does this fund transfer and all this happens? So to control all this, we have a separate group of intermediaries who will handle all this. Now, who are they? What are their functions? Let's just quickly understand it. So stock brokers, the first intermediary that I'm going to talk about is stock brokers. Now, who are these stock brokers? Stock brokers are The Zerodha, which we use for trading, or Upstock, or Ellis Blue, or Angel Broking, whichever portal you use, these are nothing but stock brokers. So these are the corporate entities who will be given license to act as stock brokers. Now who will give this license? SEBI will give license to these people who will control the entire process of trading which is done by us. So what we need to do is, we just need to open an account with them. They will give us a username, password and all that. Once we log into that portal, they will give us the platform where we can trade or where we can carry out our transactions. Now they will look after all our fund transfers, and they will make sure that whatever transaction we do, the back-end process is carried out smoothly. So will they do it for free? No, they will charge some fees which is called as brokerage. So the next intermediaries are depository and depository participants. Now who are these people? You know, the physical form of shareholding is ruled out now. Now whatever shares we buy will be held in a separate electronic form, separate account in electronic form, which is called Demat account. Now you might be knowing, whoever has opened the account, do we open a separate account like in Zerodha, in Upstock or in any other trading portal, and then do we again apply for Demat account and do anything? No, right? Why is that? Because the stock broker with whom we are dealing with will have tie-up with these depository or depository participants who will take care of this entire Demat account. So we need not do any separate process to open Demat account. The moment we open the trading account, our Demat account will also be opened with the depository and depository participants who will take care of all our transactions. They will make sure that the shares that we bought will go and sit in our Demat account, and whenever we sell those shares, it just gets away from that Demat account. There are right now two depository participants, that is National Securities Depository Limited (NSDL) and Central Depository Services Limited (CDSL). You might have noted, whenever you trade, after that day you will get a message, a mail from these CDSL or NSDL, okay, telling that the shares is the shares that you sold, the shares that you bought is this much. This is nothing but coming from the depositories, that is the people who hold your Demat account. The next intermediaries are banks. Now why are these banks required? To facilitate our fund transfer. Whatever transaction we do is routed through bank account itself, because the funds will be there in our bank account. We need to transfer the funds to the trading account from where trading happens, and then we will again transfer the funds whichever is there after our transaction in the trading account to the bank account, right? So the main person which is involved in this is banks. So banks are also one of the important intermediaries. The next intermediaries we are talking about is NSCCL, that is National Security Clearing Corporation Limited, and ICCL, that is Indian Clearing Corporations Limited. Now what does these intermediaries do? Actually the buyer will buy the shares, right? Now from whom will he buy the shares? The buyer will not know from where he will buy the shares. He will just place the order and the order will be executed and it will sit in your Demat account. Now from where you will buy the shares or who are the sellers, all these matching work will be done by these two intermediaries, that is National Security Clearing Corporation Limited and Indian Clearing Corporation Limited. These are the intermediaries who will take care of this matching between the buying quantity and the selling quantity. Now you might buy 10 shares, there might be someone else who is buying 5 shares. Now you have to find the seller for these 15 shares, right? Now sellers will also not be in the same, not willing to sell in the same quantity as you place the order. The seller might want, say, around 100 quantity and you are buying 10 quantity. Now matching all these things is again a big task, which will be again in the back end done by the intermediaries NSCCL or the NCCL. Okay, so these are the main intermediaries that you need to know before trading. The next thing which is very important to know is what are the types of market. You have two types, that is primary market and secondary market. Now what is this primary market? Primary market is a market before listing of this particular stock in the stock exchange. Before the stock getting listed in the stock exchange, the whatever process happens, that happens in the primary market. Once the stock is available to trade to public, it becomes secondary market. It becomes a stock which is in the secondary market. So under primary market, you can say one of the type is IPO. What is this IPO all about? These days you see many companies are coming up with IPOs. Every day you'll find some or the other company coming into this IPO. What is IPO? IPO is initial public offer. That is, that company is offering its shares to the public for the first time. Now, why will a company offer its shares to a public, or before this, what are the process involved, or what are the different stages of the company evolve? Let's make a quick glance over the evolution of a company so that the whole concept of IPO becomes clear to you. Just telling that I'll invest in this IPO, that IPO is not enough. You need to know what exactly is it, why we need to invest, what is the return, possible return from that IPO. So, initially, how the whole concept of this business happen? There will be some person who will have some idea. It will be a very good idea. He believes in his idea. Now he want to put his idea into execution. Now what he needs for this? You cannot simply say I'll do business. You need to have a very good idea, and you also need to have the required funds to execute that particular idea, right? Now if your business idea is big, you will require more capital. If you want to just do some small business, you need a little lesser capital. So again, that depends upon the idea which is there inside that particular person. So when this business idea is formed, you need to have the capital. Now if your business idea is big, you need to have more capital. So you need some people whom you know, or whom you can contact to invest or to put some money into this business idea so that you can effectively execute it, right? Now idea can be yours, but the fund which is available with you may not be sufficient to start this business. So you will contact a few people, and you people together put in some money. Now these people who come together initially to start this business idea are nothing but promoters. That is, the people who start the business. Okay. Now again, when it comes to a company, it's not just that we just put in this much money as capital. Now if it is a partnership firm or a sole proprietorship business, then you will put in your capital, and that will sit in your capital account. That is, say I invested 10,000 and started the business, if it is proprietorship business. If it is a partnership business, say me and two of my friends invested and we started around 1 lakh and we started the business. But when it comes to a company, it is required to allot shares. Okay, in order to say that I hold these many shares, or my capital contribution is this much. To say that, we need to hold some shares. So the price at which we purchase the shares, that is our initial promoters, that's what I was referring in the previous section of this session. So the shares that I purchase as a promoter, yes, that will be my shareholding, and the value that I pay to purchase that share being a promoter will be the face value. That is when the face value is fixed, and this is a fixed price which will not be changed at any stages of the evolution of the company. So face value is a value which the promoter will pay to buy the shares of that particular company. Now once this company is formed, a few years it will grow, it will take time to stabilize, and now you want to expand this company. You promoters come together and decide to expand this business. Now to expand this business, you need further capital, right? From where will you get this further capital? You can contact some of your friends, or you can get some links from different people, and you can go to some particular person or people and ask them to invest in your company, giving them the clear idea of what is your business all about, what is your forecast of this company, where are you looking that company after a few years. Okay, by convincing them, if they are convinced by your business venture, and if they are interested in the type of business that you're doing, then they will put in their capital. Now these people who will come after your company is set up are investors. These people who are interested in your business, who will invest in your business with a purpose of getting some return after some time, are nothing but called investors. Okay, now at what price will these investors buy the shares? It is not at the face value, because when the promoter bought the shares of that company was just in its very initial stage, which was just a business idea actually. So there was a lot of risk involved. That's why the price that you pay for that particular share will be very less. That is a face value, 10 rupees. Now when the investor invests, the company is a little bit grown, right? So is it okay for them also to purchase the shares at 10 rupees? Definitely not. So what will the other promoters who have already invested in the company do? They will do a valuation of the company. Now that is again a different process. There is a separate agency that will do the valuation. They will do the valuation and tell the value of the company today is this much. It's not 10 rupees, it is this much, maybe some 100 rupees. So the investors who are buying the shares now will buy at 100 rupees per share. Okay, these are called investors. Now after some time, again using the capital of whatever investors have invested, using that funds, the company will grow further. After some time, again these investors and promoters will decide to further expand the company, maybe to different states or to different countries, or they will decide to put some more fixed assets, that is some more machines or whatever is required. For that you need fund. Now to whom will you go? You can either look for some other investors, or you also have an option to go to the bank. Now that your company is stable, it has grown, banks will be more than interested to provide loans, because they will get good interest. Yes, so to increase their business, banks will obviously be very interested to provide loan to you. After this, again you will plan expanding your business to different countries, to different localities, or you want to go to different product line, anything, any type of expansion, and you don't want to take further loan because you have already taken the loan, or even if you skip this whole process of bank loan, you might feel paying interest to the bank is not that feasible. In the initial stage itself, if you don't want to go for bank loan, company can decide to skip that entire process of bank loan. So what is the next option that is available to you? You can go for IPO. Now what is this IPO? You are making the shares of your company available to the public for the first time. Now is it that easy? Can you just go and register yourself under SEBI and just say that the share price is this much, it's available to public at this price? No. Initial public offering itself is a separate process which will involve a lot of authorizations, a lot of permissions to be obtained, and it's whole process which will take some time in order to get your shares listed in the stock market. What are those processes? Initially, you have to appoint a merchant banker. Entire IPO procedure is to be handled by a banker who will be called as a merchant banker. So, appointment of merchant banker is very important, which will be the first step. Then you have to apply to SEBI and obtain permission from the SEBI for this initial public offer. Then you will have to circulate a document called DRPH. I will not go in detail with these things because you just need to know what actually happens, that's all. No need to go deeper into this because it's not required for you while trading. So DRPH is nothing but a document which will be circulated among the people, which will say the purpose for IPO, how many shares are they giving, they are leaving to the stock market to get traded, and what is the purpose for which those funds will be used. Now the moment you say I need money, it's also required for the company to give details of why is that initial public offering happening, why do company need money from public, why are they for what are they using that money, and what is the future forecast of that company. All these details along with the financials again, because to do fundamental analysis we need the financials. So along with the balance sheets, P&Ls and all those financials, the whole document of DRPH will be given for circulation. Next is IPO marketing, because people should know that IPO is going to happen of that particular company. So marketing is done using different media, that is either to television or newspaper or any such medium. Price band is a range which is given by the company telling that public can offer to buy the shares between this price, say from 1000 to 1200. This range which the company fixes is called price band. Okay, it will say that you can buy the shares of the company, you can quote a price between 1000 to 1200. So this is called the price band that will be quoted. Next process is book building. Book building is a process wherein public will quote the price at which they are willing to buy the shares. Okay, so placing an order in the IPO is nothing but you will be telling that I am willing to buy these shares at this much. So the price that you are quoting, again the price that you quote should be in that price band which is given by the company. If the company says we are willing to give you shares between 1000 to 1200, then you have to quote a price between this 1000 and 1200 only. So this whole process is book building, that is the public quoting their price which they are willing to buy. Next is closure process, that is the whole analysis is done and finally the company will come into conclusion based on offers that is given by the public. A final price will be fixed. This is the entire closure process of IPO. After fixing that particular price, listing will be done and whoever has allotted will be given the shares. Whoever has applied will be allotted the shares. Again, that is another process, we need not go deep into it. So the entire IPO procedure will happen like this. If the company wants to raise money and it has already raised money from the investors and banks, or if the company doesn't want to use any of these options, if it want to directly go public, then initial public offering will be done, and this is a separate procedure which will require permission from SEBI. Again, few compliances are required to be done. After all the compliances are done, the shares of the company will be given to public to trade through NSE or BSE, and this entire procedure is called IPO procedure. Now, until the company's shares becomes available for public to trade in NSE or BSE, until then it will be said that the shares are in the primary market. Okay, once the shares are listed and available for public to trade, you say the shares are in secondary market. Okay, hope this is clear, the concept of IPO. The next important thing that we need to know is the factors that affect the market sentiments. As I already told initially, it's very important to know the market sentiments, to read the market before you trade, because the movement of the market is what is very important. How the market moves, we need to move in the same direction, right? So that we can make something out of market. If we just go and say I want to make 5,000 today, I want to make 10,000 today, it's not, market is not that easy which will just give you money as and when you need. So you need to clearly understand the market sentiments. For that you need to understand what are the factors that will affect this market sentiments. First thing is management change. Let us say if a company's management is changed, the moment this news comes in, either the stock will fall or the stock will move in the upward direction. Why so? If it is in the negative side, that is, say there is no proper control now, if something like this, some news like this come, obviously price of that stock will decrease. Similarly, if some good management happens, some good takeovers happen and you expect that company to grow, then obviously there will be a lot of purchase and the share price will move upwards. Similarly, if there are result announcements, that is every quarterly the listed companies are required to announce their results, that is their financials. So if their financials are good, obviously people go on buying the shares, so the value of the share increases. If the financials show bad results, then obviously people start selling it because of the fear, the panic that is created, so the value of the shares come down. Next, general news impacting any particular sector. That is, if any, say IT industry might be affected if something happens. Now say, because of this COVID, you can see this pandemic, what has happened is almost all of the IT companies shares fell, right? That is because this has affected entire IT sector, because the offices were asked to close, the people were asked to work from home, and all these things happened. That is a complete effect on the particular sector. So sectorial effect can also affect the market sentiments. Then budget. of course, if we have any news coming in regarding budget, there will be either upward movement or downward movement. If we say budget is very good, then people start buying the shares without anything. This is just a common sense. You need not know what is it all about, what exactly the talk going on regarding the budget. Just a positive comment will make the market to move upwards. Just a small negative comment regarding budget will make the market to fall. Similarly, increase in repo rates and reverse repo rates. Now, what are these repo rates and reverse repo rates? Repo rates are nothing but the rate at which RBI gives loan to other banks. Okay, repo rate is nothing but the rates at which RBI will give loans to other banks. Similarly, reverse repo rates are nothing but the rates at which the other banks give loan to RBI. Okay, now if these rates increase, then what happens? Obviously market will fall. Why? Because when the rate at which the RBI gives loan to the bank increase, the capacity of giving loans by the banks to other companies will also decrease, right? When the rate of interest at which the RBI gives loan to the bank increases, the bank will not give the loan at a lower rate to other companies, right? Bank will also charge more to other companies. So the loan taking capacity of the other companies will decrease. So the fund flow will decrease. So company cannot expand further. That's why the shares of that company will also come down. Similarly, increase in reverse repo rate. If the rate at which the bank gives loan to the RBI increases, what happens? Banks, instead of giving loan to the companies, will start giving more and more to loans to RBI. Why? Because it will get more return if it gives loans to RBI. It will get less return if it gives loans to corporates. So the fund flow from bank to the corporate will become less, and the fund flow from bank to RBI will become more. So the companies will not get the required loans at that less interest rate. So the fund flow will decrease. So the expansion of the company will not happen. The share prices will decrease. So the increase in repo rates and reverse repo rates will also impact the market because of less fund flow in the corporate sector. The expansion of the corporate companies will come down. So the share prices will also go down. Similarly, the company forecast. Now companies along with their results will also announce their forecast. Now if the forecast is good, obviously the market will move upwards. If the forecast is bad, then the stock of that particular company will come down. Hope that is clear. Now let's come to the main part, that is trading part. How does this happen? What is a procedure for this? I will show this practically also at the end of this session as to how to place the order, how will you do the trade. Before that, let's understand the basic concepts. First is order placing. This is nothing but you will place the order telling that I will purchase these many shares and at this rate. Then fund verification will be done by the stockbroker. As I already told, stockbroker is an important intermediary who will handle all of our transactions in the back end. So once the order is placed, fund verification will be carried out quickly. Then stock will be purchased from the stock market for us. Then it will be accumulated in the demat account, which is maintained by NSDL or CDSL. So you can see how fast all this process happens in the back end as soon as we place the order. So there are so many intermediaries who will be working at the back end who will help in very quick execution of our transaction. So next, let's see if you want to trade, what type of trader we can be in the stock market. You can be either intraday trader or a scalper or a swing trader. Intraday trader is a trader who will trade in a day, that is he'll buy the shares and sell the shares in that particular day itself. That is entry and exit on the same day. These are intraday traders. They will get a margin also for this from the stockbrokers. Now you can also be a scalper. Now what is scalping then? Scalping is entry and exit within few minutes. Technically I can say they will buy the shares at a very large quantity, but they'll trade for a very small time frame, that is within a minute. There will be quick entry and quick exit, making some quick profits. These are called scalpers. Then we have swing trade or swing traders, wherein they take some long positions. They hold the shares expecting a very good return from these stocks. So they will do, most of them go for fundamental analysis and buy the shares, and they will hold the shares for long term in order to earn some good profits. So the next term, which is again important, is stock market index. Now, what is a stock market index? Say if we want to know infrastructure of a particular country, say how well is a country with regard to infrastructure, that is roads and all that. We don't go to each and every nook and corner and check how is the roads over there or how is the infrastructure development happening. What we do is we select some basic cities and see how well it is developed and say a particular country is very well developed or not with respect to infrastructure, right? Similarly, in BSE we have around 5,000 listed companies, and in NSE we have around 2,000 listed companies. Now, is it possible for us to go and check each company and decide whether the market is moving in the upward direction or downward direction? Or is it possible to go and analyze each of these companies and then decide where will we invest and all such information? Or to know at large how is the market moving, is it possible to go and check each of these companies? Definitely not. For this, there is a particular index which is formed wherein few companies or reputed companies from a particular different sectors are selected, and based on the movement of these few picked companies, we decide how is the trend of the market. Okay, so the first market index that I am talking about is Nifty 50, wherein 50 companies from different sectors, 50 remarkable companies from different sectors are chosen and their movement is monitored. So if the majority of the stocks that are listed in this Nifty 50 shows upward trend, then we say market is moving in the upward direction or this index is moving in the upward direction. And if the majority of the company shows downward movement, that means Nifty 50 is moving in the downward direction. Similarly, Bank Nifty, this is again with respect to particular sector, that is different banks, around 20 banks are kept in watch list. Similarly, we have Nifty Finance and we have MCX with respect to commodities, okay, which is becoming prominent these days, which was not that actively traded in the past years. So this is about stock market index, that is which will give you an overall view of the market. Now, you might have heard the term pre-open market, right? Every time we say when we select the stock, also check the pre-open market. Before trading, check the pre-open market. What is this all about? The time between 9 to 9:15 am, 9 am to 9:15 am is considered to be pre-market session or pre-open market. What is this actually? See, now market will move in the minds of the people, as I already said, right? How can you say that? This can be proved by the fact that the price at which the stock closes the previous day will not be the price at which the market or the stock opens the next day, right? Today if the stock closes at 100 rupees, tomorrow the stock will not open at 100 rupees. There will be there can be a little more price of that particular stock, or the price of that stock might have gone little down, or there can be gap up opening or gap down opening. Why is this actually happening? Because after the market closes at 3:30 p.m. till the next day's opening, that is 9 am, there will be a lot of market sentiments happening. The market will move even in our minds. How is it possible? Again, I'll tell you in the next part. So 9 am to 9:15 am is a pre-open market wherein you can place the orders. Okay, whoever want to buy the shares can place the orders, but the execution will happen only after 9:15. So between this 9 to 9:15, the market will analyze, that is at the back end, all these intermediaries will work and analyze what can be the movement of the stock market before opening itself. So who will be helped by this? The small retailers who want to invest can get an idea as to what can be the fluctuation, so that they don't end up in making huge loss. That is the main reason behind this pre-open market. In the pre-open market itself, you will get to know what is the opening of that particular stock, or what can be the trend of that particular stock, and more of the fluctuations, whatever happens, will happen in this time only. So once the market opens, the market will start moving in a stabilized manner. So to stabilize the market, first 9 to 9:15, 15 minutes is given as pre-open market, wherein you will get a clear idea as to how can the market move, so that once the market opens, the movement will be stable. Similar, that's what it absorbs the volatility of whatever is involved. Very volatile session will be completed in this 15 minutes. It will stabilize the market once the market opens. Now, what is the market hours? We all know 9 a.m. to 9:15 is what I explained, pre-open market session. 9:15 a.m. to 3:30 p.m. will be the trading hours, that is all our intraday players and all of the other people who want to buy or sell the shares will transact in this trading hours. Now, 3:30 to 4, again it's a time for this back-end workers, whatever adjustments they have to do, that will happen. Then from 4 p.m. to next morning 9 a.m. is called after market order hours. What is this after market order hours? This is nothing but what I was referring to as the market sentiment. Market moves even in our minds. That is, if you want to invest for a long term, then you can buy the shares even after 4 p.m. From 4 p.m. to next morning 9 a.m. also you can buy the shares. But when will this be executed? It will be executed only after 9:15 when the market opens. Then why you need to go to buy during these after market orders? That is because if you are a long-term investor, then a small variation in price, that is 10 rupees, 100 rupees or even 200 rupees does not matter much when you want to hold a particular share for a long term, right? So when you are not able to trade during the trading hours, that is when you are a working person or something like that, you are occupied with something else, you can come home back after 4 a.m. you can relax and place your orders. That is the main purpose of after market orders. That is, if you are holding for a long term, you can buy the shares even after the trading hours, but the execution will happen only at 9:15 a.m. in the next morning. Okay, that's why we have this close and open will not be the same. Previous day close will not be equal to the next day opening. That is because of this after market orders. Next, let's quickly see, if you are analyzing the stock market, what are the terms that you have to know? One is trend. Trend is nothing but the way of movement of the stock market. Then bullish market, as I already told, bullish means upward movement. Bullish market means stock moving in the upward direction. Bearish market means stock falling or moving in the downward direction. Face value of the stock, as I already explained, the value at which the promoters bought the shares, that is the initial value which will not change along with the change in time. Market value is a value at which the stock is traded right now in the market. Okay, that is a present trading value of the particular stock is a market value. All-time high or low, this is another important term which is used frequently in technical analysis. All-time high or low is nothing but if the stock is, the price of that stock is at a level or say at a price which is the highest, that is in the previous days, if that stock has not reached that level, that price, then that is an all-time high. Similarly, if the stock is at a price which is so low that the stock has not touched that price till now, then it becomes all-time low. Previous day open close is as I already explained, whatever price the stock closes in the previous day will be the previous day close. Previous day open is the price at which the stock opened on the previous day. Long position is, or going long means you are looking for a buying opportunity in a particular stock. Similarly, short position means or you also say short trade or short position. Okay, this means you are looking for a selling opportunity. When will you look for a selling opportunity? See, now if I buy a stock and then sell it at a higher price or lower price, that doesn't become a short position. Buying a share, holding it and then selling is not a short position, that is long position. Okay, when will it become a short position? Only when you are looking for selling without actually owning that shares. What you are actually doing is you are just borrowing the shares and selling. Again, you will have to square off the transaction by buying the shares. So first buying and selling is called long position. It is not a short position. First buying and then selling is long. First selling without actually owning the shares is called short position. You are looking for a selling opportunity without actually owning the shares. That is short position. You are just borrowing the shares and selling it. Later when the price moves, you will buy those shares. And this short position, you cannot do it in cash. In cash, you cannot directly go for a short position. Only in futures, this option is available, going short. So the next is bid price. Bid price is a buy price, that is the buyers offering to buy the shares at that price, that is bid price. It will come along with the number of buy orders if you check in the trading portal. Again, I'll practically show it in the portal. Offer price is a selling price, that is the price that the sellers are offering to pay to buy that particular share. So the next thing is, important thing is square off. We say squaring off the particular position that we hold. What is the square off? Squaring off is nothing but closing the existing transaction. That is, if you are in a long position now, that is if you have bought the shares, square off means selling that shares. If you are in a short position, that is you have already sold the shares without actually holding it, then buying the share becomes a squaring off. Squaring off is nothing but exiting from the current position. Okay, so volume is nothing but the volume of the shares, what is the quantity that is being traded in that particular stock. Intraday position I already explained, buying and selling, that is entry and exit on the same day. Futures and options again is a type of derivative which derives its value from the underlying asset, which is nothing but shares. Futures and option in detail you will get in the next video, that is basics of options. So let's quickly look into few terms which are again required for us to know. These are the basic terms. Without knowing this, if we directly go and do trading, there is no point. You need to understand few basic terms in order to know what are we exactly doing. If you want to take it up, or if you want to sustain in the market for a long term, it's also required to know some of the basic concepts of what company is all about, what are the different terms, how are the returns given by the company, and all these details, so that the entire concept of stock market becomes clear. So dividends, what are these dividends? Dividends are nothing but a return that is given by the company to us for investing in that particular shares of that particular company. So it is distribution of profits or reserves. Whatever the company makes, whatever profit it makes, it has to distribute it to the people who invest in that shares, right? Because by investing in the shares of a particular company, you become owner of that company, at least to that extent, right? To the extent of how many shares you are holding or what is your investment, to that extent you are the owners. Now when you are owners, you are also entitled to the profits of that company, right? So how will this profits distributed? That is through dividends. Now how the dividend is paid? Some people say, oh, the dividend is around 50%, dividend is 40%. Now what does it mean? They are paying dividend on face value. It is not on market value, as in the first example where we spoke about. Face value of Nestle India is 10 rupees. Now if I say, if the company says we are paying 80% dividend, that is they are paying 8 rupees on one share that you hold. It is not 80% on the current market price, it is 80% on the face value. So dividend is always paid on the face value, as a percentage of face value. Again, it is paid per share. The moment they say dividend is 80%, it is for one share, it is 80% dividend. Now, is this dividend declaration compulsory? No. Dividend declaring is not compulsory. Now you may say, I am the holder of that particular share, I am the owner to that extent, why am I not entitled to dividend? Dividend declaration is left to the company. It is not compulsory for a company to decide dividend. Now what can be the clarification given by the company? If you just check the biggest company which we consider, Apple, Google, they have never declared dividends. What they say is, if we declare dividends, we give you some 8%, right? How much ever good dividend we declare, what you will do with that? You will just invest it somewhere else, right? But if you invest anywhere other than in the stock market, you will not get that much return as we give from the stock market. That is, if you invest in FD, you will get around 4 to 5%. Or you invest in any other source, the max to max return that you can get is around 8%. But if we don't give you dividend and we use it for expansion of the business, then our share price will grow up to 15 to 16% a year, right? So instead of giving dividend, indirectly we are giving you profits. That is what the company says. So it is not compulsory for a company to declare dividend. Now previously, before 2020, dividend was not taxable. So if you receive the dividend, it is tax free. But now it is not so. Even a single rupee of the dividend that you receive is taxable. Next, let's see what is bonus issue. Now, what is bonus issue? This is an issue which is received against the current holdings, wherein you will receive free shares against your shareholdings. Okay, now this is issued out of the reserves. If a company is issuing 2:1 bonus shares, that means you are going to get 2 shares for every 1 share held. So right now, if you are holding 100 shares, after bonus issue you will be holding 200 shares. Okay, this is actually, if the company is having huge reserves, then to clear out this accumulated reserves, this bonus issue will be done. You might have frequently heard about the term right issue. The company is going for right issue. What is this right issue? Right issue is nothing but raising further capital for again expansion or development of the company. But here, instead of offering it to the public at large, what the company does is the shares will be issued to the existing shareholders. Okay. Now again, while issuing the shares, they will keep the price of the share a little lower than the actual price at which it is traded. So right issue is an issue wherein the shares are issued to the existing shareholders at a lower price, okay, for the purpose of development of the company. So the another frequently used term is buyback of shares. What is buyback of shares? It is nothing but the company buying back its own shares from the investors. Now, what is the necessity for the company to do go for buyback of shares? If the company feels the number of shares that is available to trade is too much, and if the company want to withdraw a little bit, then the company can buy back the shares from the market itself. Or if it wants to improve the productivity of the company, that is if it wants to raise the per share income of the company, then it can go for buying back. Or if the company feels that someone is planning to take over the company, that is, when can someone take over the company? When a company buys more than 50% shares of the other company. Again, it's again a different term or the different concept, but by doing that, the control of this company to some extent goes to the company which bought the shares of more than 50%. So if the company feels there is something going on in the market wherein taking over of the company might happen, to avoid this, the company might buy back the shares to be on the safer side. Next, let's see what are the charges that is applicable. This is again, the most of them wanted this information. So whenever you transact a business using any portal, the charges that will be charged are, first is brokerage. Now, as I already told, stockbroker will give you a lot of services in backend. Most of our trading activity is controlled by these stockbrokers, and they charge brokerage for the services that they provide to us in the backend. So now, what is brokerage? Depends upon the broker. Different brokers charge different brokerage. Then securities transaction charges, this will be charged irrespective of whoever is the broker. That will be 0.1% of your total transaction. Transaction charges is 0.00325% of your total transaction. Then service tax will be charged, and this will be 12% of the brokerage, whatever the broker is charging, plus the transaction charges, whatever is applicable to that particular transaction. Then upon the service tax, you will have education cess, which is 2% of service tax. You have higher education cess, which is 1% of service tax. Then also SEBI will also charge 20 per crore. Okay, so these many charges will go along with one transaction that you carry out. That's why sometimes people end up saying more than profit we end up paying brokerage, but you cannot help it. Brokerage will have to be, these charges or the transaction cost will have to be paid because it is a rule of the government. Now, whenever you see in an IPO, there will be two categories, if you can see. One is RII, that is retail individual investor. Then HNI category, that is high net worth investor. RII, that is retail individual investor, and HNI, that is high net worth investor. So, what is it all about? These are nothing but categories of investors. There are different categories of investors, and the first one being retail individual investor. Here you can say it is individual, retail individual investor. That is whoever applies for an IPO or whoever buys the shares which is less than or equal to 2 lakhs, then they come under the category of retail individual investors. Similarly, if anyone is buying the shares costing more than 2 lakhs, then they will come under the category of high net worth investor. Okay, again here high net worth investor, that is a single person. Whereas the next category, that is DII, domestic institutional investors. Now these are not individuals, these are institutions, as it suggests, name itself suggests, it is domestic institutional investors. Now who fall under these categories? Mutual funds. Yes, these people invest in the shares, right? So they are not individuals, they are institutions. So mutual funds. Similarly, LICs. Now whatever premium they collect, where do they keep? LIC collect so much premium from different people. Where do they keep it? They will invest in order to get some return from it. Where do they invest? In shares, right? So LIC comes under domestic institutional investors. Who else? Insurance companies also invest. Similarly, some banks also invest. All these will come under domestic institutional investor. Next, FII and FPI. FII is foreign institutional investor and FPI is foreign portfolio investors. These are people who invest in foreign currency, not in Indian rupees. They will invest in foreign currency and that will be converted into Indian rupees. So usually they will have a huge impact on the movement of stock market. If FIIs sell or exit their position, usually they will be in large quantities. So when they start selling their positions in large quantities, it will have a huge impact on our stock market. So it might fall drastically. So FII and FPIs also play an important role because they trade in foreign currencies with huge quantity. So these are the 4 categories of investors which you have to just know. Now coming to the next part, that is while trading, what are the type of analysis that we need to do? The first is, which I always talk about in my YouTube channel also, that is technical analysis. What is technical analysis? It is nothing but analyzing the past data. We analyze the past data and we predict what can happen in future, right? If we take any example, we say past repeats, right? Whatever happens in the past will repeat in future. So how can this technical analysis happen? There are different charts which you can use for technical analysis. Line chart, candle chart, area chart, many are there, but the famous one or the most frequently used by the traders is the candle chart, which gives you more clear picture and helps you analyze in a more precise way. So I'll also show a demo of this practically. Another analysis which is very important for if you want to be a long-term investor, then it is fundamental analysis. Now what is fundamental analysis? Fundamental analysis, as the name itself suggests, understanding the fundamentals of the company. Okay, that is it can be a qualitative analysis or it can be quantitative analysis. Now qualitative analysis is mainly based upon the factors in large about the industry, about the company, about the background of the company, about the promoters of the company and all such qualitative aspects. This does not involve any figures. Analyzing of figures or financials is not covered under qualitative analysis. Here it is mainly understanding the background of the company and understanding the structure of the company. That is qualitative analysis. The next one is quantitative analysis, which we being chartered accountants are more than interested. That is knowing the financials of the company, analyzing it and studying what can happen in the future with that company. How can the company grow? Will it give returns? How much returns it can give? All these predictions are based upon quantitative analysis. So what are the things that are covered in this qualitative fundamental analysis? We check revenue details, okay, that is turnover. Now this fundamental analysis is not something rocket science. Again, you need not be a finance person to know to analyze the fundamentals of a company. Just apply your common sense and everything will be so easy for you. Revenue means what? Turnover. Even if you are not a finance person, wherever if you want to sell something, you will see how much you'll collect by selling something, right? When you are trading, you buy something, you sell something, whatever remains is a profit. It's as simple as that. Similarly here also you have to check what is the revenue of the company. Okay, the whole purpose of business is to make money, right? Now what is the amount that you collect from sales is nothing but revenue. So you have to see whether revenue is increasing or decreasing. Also you have to compare it with the expense details, that is what you have spent for the company. Is it increasing or decreasing? Then you have to also see what is the interest, what is happening with the interest. Is it growing or is it coming less? If the interest is showing a huge increase, that means company has taken a lot of loans, right? Which is not actually a very good sign. Now if the company has taken a lot of loan and if expansion is happening, sales is increasing, then it is fine. If your revenue is not increasing, expenses is increasing, interest is increasing, that means it is not a good signal. This is how you have to analyze. Again, I will show a separate financials of any one of the company and explain it in detail. So as of now, just know what are these items. Okay, practically how you have to apply it, I will tell you in the last part. Then taxes. Obviously taxes will also affect, like what kind of company is that, what sector does it belong to, all these things. Based on all these things, taxes vary. Then you have to see what is the profit that the company is making, which is very important. Again, there is bottom line and top line. Okay, always bottom line is of more importance. Top line is nothing but this revenue details, you also tell it as top line item. Profits after tax, here profits in the sense this bottom line, PAT, this is very important. One can be profits, that is before taxes. The next line would be bottom line, that is profit after taxes, which is very important. If PAT is growing in a very good scale, that means company is in a good state. Then you have to see how the share price is increasing. This you can get in any of the portals, right? You have to see what is the share price, is it increasing or is it coming down? That is also important to know. Similarly, you can check a compounded annual growth rate. This will be given in the financials, okay? What is a compounded annual growth rate? Now, if the compounded annual growth rate is good, if year by year a good compounded annual growth is happening, then it means it's a good sign for the company. That is, you can go for consider investing in that company. Similarly, you have to check for reserves. If the reserves are growing, that means good. If reserves have come down, then you have to see if there is any bonus issue happened or if they have given dividends. If yes, then that is not a big issue. But if the dividend is not declared, bonus is not issued, reserves are not used, but reserves are becoming less. Year by year, the percentage of increase in the reserve is going on decreasing, then that can be a matter to be considered. Similarly, you have to check for borrowings. If the company is taking a lot of borrowings and business is not growing, then it is a sign that company is in trouble, or we don't know where they are using that money. So you have to check whether borrowings are increasing or decreasing. And current ratio, debt equity ratio is also a very important ratio which you have to check if you are going for fundamental analysis. Debt equity ratio is something which relates the debt, that is whatever debt the company, the liability which the company has to pay, to equities. Okay, it is again another term which is used. You should have a good debt equity ratio and a current ratio in order to know that the company is in a good state. Then PE ratio, that is profit to equity ratio. This is also something which you have to see. Being a non-financial person, you have to just see whether it is growing or whether it is increasing or decreasing, and you have to analyze it. Now, how will you do that? I will show it with the help of an example itself, otherwise you will not be able to understand. But just look at the items which you have to see when we do that analysis in the financials. We have to see the revenue, we have to see the expenses, interest, we have to check the profits, then we have to see how is the share price. Then if possible, we can also analyze the compounded annual growth rate, then check for reserves, borrowings and PE ratio. Let me quickly show you how this fundamental analysis is done using an example of Hindustan Petroleum Corporation Limited, that is Hind Petro, which is there in Nifty 50. Okay, so any stock, if you want to know the fundamentals, or if you want to do fundamental analysis of any stock, then moneycontrol.com is a very good website wherein you will get all the information. Okay, here you can see they'll give the value, BSE value as well as NSE value over here in the top, and both for BSE and NSE you will get what is the previous close value, what is the price at which it opened, the stock opened on the day, what is the bid price, what is the offer price, everything you will get in this money control website. Even the volume that is traded is also given over here. You can check it out. You can check it out for any company for that matter. You will get complete details of that company over here. Even they will give you the fundamentals, that is financials of that particular company. You will get the P&L account, you will get cash flow statement, you will get the balance sheet. So the basic thing which we have to check while doing the fundamental analysis is a profit and loss account of previous, say, 5 years at least, and balance sheet for again previous 5 years, as well as cash flow statements. Now when I say profit and loss account, balance sheet and cash flow statements, for a person who is new to finance or who is a person without knowledge of finance will find it difficult to understand. But let me make it easy. Profit and loss account is nothing but that will tell you, is a company making some good profits after paying all the expenses, or is it running under loss. Similarly, balance sheet will tell you what is the asset, or what is that the company is holding, and what is that the company need to give, that is liability. It will talk about assets and liability. Similarly, the cash flow statement will give you the brief summary of how much cash has come into the business and how it is used. Okay, has it used well? Is there enough cash in the business? Now, having just assets, liability, having the business revenue, all these things are not sufficient. Company should also have some good cash ready with it, that is cash in the sense something liquid ready, so that any emergency can be met. So we need to analyze all these three statements before coming to a conclusion as to whether the fundamentals of the company is strong or not. So let me start with analyzing the P&L account. This will help you to also see which are the items which are to be considered or analyzed before coming to a conclusion as to whether the shares of that particular company is to be bought or not for long term. So here if you check, the first item which will be given in the P&L is revenue from operations. Just check how much is the revenue each year, that is it growing or is it falling. In this case you can see year after year revenue is growing, right? Similarly, if you check here total revenue, you will get to know year after year it was growing, total revenue, but this year, that is 1920, it has come down, right? From 2,76,889 it has come to 2,70,000. So now just based on this revenue you cannot conclude everything. Now we need to look other items also to see is the company is in a good position, because a small decrease in revenue will happen sometimes. So just based on revenue you cannot base your final conclusion. So let's move forward and see what about the expenses, what has happened with respect to expenses. If you check expenses, you will get to know expense is also increasing gradually, right? But between the last year and this year, that is this one 1819 and 1920, there is no much difference in the expenses, right? It is almost here it's almost the same. Now in expenses you also need to consider one item which you have to closely observe, is that a finance cost. See, finance cost has increased drastically when compared to last year, right? Here it was 640, then it came down, then again it came down, and in 2018-19 it went up to 725, and this year that is last year 1920, it increased drastically, which means the company is taking a lot of loans. In 1920 company took lot of loans. We don't know why, because loan is taken, more of loan is taken, maybe for expansion we can say, but did the sales increase that much? No. You can see here sales has decreased, right? From 295 to 286, sales revenue has decreased, but loan repayment has increased. Now this can be when will you repay more loan? Only when you take more loan, right? Which means they have borrowed a lot from the bank. So this is not that good a signal. So this can be a negative side of this company. So let's move further and further analyze to see what exactly has happened. The next important thing which you have to see is profit for the period. This is called the bottom line item, that is after all the taxes, the last profit which you get is called PAT, okay, profit after tax, and this is the one which you have to analyze. This is before continuing operations. Some companies will have these figures different than these. You need not bother much about it. You just see PAT, profit after tax. This will give you a very good picture actually. Here if you see, the profits after tax were very good in the previous years, right? But here in 2019-20 you can see a very big fall in the profit after tax, which is again not a very good signal. So you can see the borrowings has increased because interest payment has increased over here. Finance cost is nothing but repayment of interest. So interest cost is increased, which means the company has borrowed a lot, revenue has decreased. Again here the profit after tax has decreased drastically from 6028 to 2637, which is not at all a good sign, okay. Please make a note, whatever figures given here are not in thousands, these are in crores. Here you can see in rupees, crores, okay. Instead of giving elaborately, they have converted it to small figures. So these are in crores, all these figures. Here profit 2637 means 2637 crores, okay. From 6028 crores it fell to 2637 crores, which is not at all a good sign. Again if you see EPS, earnings per share, this is also very important. See, earnings per share was 114.07 when 2015-16, then it gradually started decreasing. Here it decreased to 40.74, then 41, then 39, and at 1920 it's 17.31, which is again not at all a very good sign. Next, if you go on moving forward, you can see the dividend share, equity share dividend is paid, okay, dividend is paid. So now just because, see, by looking at this, what you can make out is dividend is paid, yes, equity share dividend 1432, which is more than the previous years, right? So just because the company is paying out its dividend does not mean the financial condition is very good. Sometimes what companies do is, just to hold up their value in the market, they pay the dividends, though they are not running in a very good condition, still they pay the dividend in order to maintain their stand in the public. So just because the company gave the dividend does not mean the financial condition of the company is very good. Here, looking at the earnings per share, looking at the profit after tax, it shows company is not in that good position. So next, let's analyze the balance sheet for more information. In balance sheet you can see reserves is increasing, which is again a good sign. You can see here from 26,650 crores to 27,438 crores. The reserves has increased, that is good. Share capital has also not changed. The next thing which you have to see is, when we analyze the P&L, we got to know interest expenses more, finance cost, okay, it has increased. So where exactly it might have effect on the balance sheet? Increase in finance cost means increase in payment of interest, which means the loan taken is more. So let's check long-term borrowings. Under long-term borrowings, all your bank loans and all those long-term loans are covered. So if you see here, it clearly says from 11,317 it has increased to 22,287, a very drastic increase. Now why the company has taken this much loan, you can get to know by checking the notes to accounts of the company. Maybe company is into expansion or something. If it is like that, if the company's future plans, if you check, if it is good, if they are into expansion or if they are into new venture, then that is fine. Otherwise you will have to see, is the company suffering from the required fund for running the business. If that is the case, if this is because of the operating difficulty which is there in the company, then this is not at all a good sign. This is the main thing which you have to look into. Other than that, short-term borrowings and all is fine. There is a small increase that doesn't make any big difference. You can also make out by checking in the fixed assets if there is any big change in the fixed asset. That means, have they taken this loan to purchase something big, some capex requirement in order to expand the business. Here if you can check, yes, from 40,523 your tangible assets or the fixed assets have moved to 47,746, which means, yeah, they have made some investment in fixed assets. So this can be a sign that the company is into some expansion, some further development. You can see the capital work in progress is also moved drastically from 9,495 to 17,143. So this clearly gives a symbol that a company is into something big, so as to grow its business. Then I don't find any big change in the balance sheet. Next, let's check the cash flows of this company. You need to check for 5 years at least, and I don't want to go into the technicalities of this because I'm sure you'll understand it only if you have the financial background, because deep into it is not necessary for a common person to invest. So the main thing which you have to see in this is the cash flow, net cash flows should be positive for at least 3 years. Okay, these cash flows should be positive for at least 3 years. In this case, if you see, it's actually negative for all 3 preceding years. So it is not at all recommended to go for this because we don't know what will happen. If you have a negative cash flow, it is not at all good for the company. So what I can say is cash flow is not favorable. Even a balance sheet doesn't look that good. Yeah, dividend is paid, so that can be a positive sign, but again looking at the revenue and the PAT, it's not showing that great results, which means before investing in this company, you will have to look into few other factors like qualitative approach and maybe notes to accounts. You have to obtain some additional information and you have to confirm if you can go for it or not.
Let's practically see how to place the order, how to do this trading process using this trading portal. The portal that I am using here is Zerodha. Regarding technical analysis, I have uploaded already a lot of strategies in the YouTube. You can check it out. Also, if you want to know about price action, I have a separate course. You can check it out. So right now, let's see how to place the order in the portal and what are the different terms, whatever I have explained till now. Let's practically see where does it come in the portal and what is the use of those terms over here. So I'll quickly show you how to buy a stock. Let me show you how to buy sale stock. Before that, see here, bid price is given, that is the price which buyers are willing to pay. These are the orders, that is 20 orders. You can see here 2 order. This keeps on changing in the live market. This means the number of orders that are placed. 3 or 12 people over here are placing the order. That's what it means. Now order is not same as quantity. One person can place an order for even 1 quantity or 100 quantity. So the order and quantity will not be equal. You can see the total quantity over here is 33,40,000. Here you can see offer price. Offer price is the sellers are offering the price at which they are willing to sell whatever stock they are holding. Here also you will have order and quantity. Order is the number of people actually putting the orders. Quantity will not be same as orders, as I already told. So here the total traded quantity is 74,35,201. Now looking at this, depth is also important because in some strategies we also consider the depth of the market in order to analyze. This is open price, that is the stock opened at 79 rupees. You can also check that the sellers are more in this particular stock. Sellers are more than buyers. If you place the cursor on that candle, it will show you the open, high, low, close of that particular candle. You can see open is 79, high is 81.10, low is 79, and close is 80.75. So if you want to know all these details, you have to place the cursor on a particular candle, and whatever is the open, high, low, close of that particular candle, that will come over here. Now this is day actually. I have kept it as a day chart. You can change it to whatever minutes you want to consider for your particular strategy. You can also compare here. The open close is same as that given above. So here you can see open close of that particular candle. You also can see the volume that is traded. Also LTQ. LTQ is nothing but the last traded quantity that is also given here. That keeps on changing. You can see here. And this is a lower circuit, that is if the stock falls drastically more than 10%, then at 70.95, when the price is 70.95, the stock will be freezed and will not be allowed to trade for some time. This is high of this particular day. Right now I have kept day candle, so it is high. This is previous day close. It also gives you the average price. This is last traded time and the upper circuit. Similarly, like if the stock moves drastically upwards more than 10%, if it goes, then the stock will go to upper circuit, and at 86.65 the stock will be freezed and will not be allowed for trading. This is today's candle. You can see the high and low, and this is yesterday's candle. Yesterday's low. And if you keep the cursor here, you can see the open is 78.95, high is 81.5, low is 77.5, close is 78.8. You have to keep the cursor over there so that you'll get all the information of that particular candle. Now this is a day candle, so yesterday's data it's giving. Now let's buy. Let's place an order to buy. Here you can give the quantity. If it is long-term investment, then here you have to keep long-term. See, the margin that is required is shown here. For 25 quantity, 2015 is a margin that is required because you are holding it for the long term. The margin required will be more. If you are doing it for intraday, that is you want to enter and exit on the same day, then you have to select intraday. If you select this, then the margin required will be less when compared to long term. You will get leverage for intraday. If you see, for intraday, for same 25 quantity, the margin required is just 403. If you want to place the price that you are willing to buy, then you can select limit and put the price. If you place a market order, then whatever is the current running price, at that price you can buy the shares. Here you have stop loss. By selecting stop loss, you can specify whatever is your stop loss. In order to prevent the slippage, you can go for stop loss market. That is, even if the price that you quoted slips, then market price will be taken directly. You can see the stock is running at 80.70. It is executed. It is bought at 80.65. This is how you place the buy order. Another thing which you have to notice, you can see that the stock is running at 80.65, now 80.6. So it is better to place an order little below that, maybe 80.5, and a limit order of 80.5. So that even though the stock is running at 80.6, when it comes a little down, your order will be executed. Usually the stock will not be at the same level. It will just go up and down a little bit. So you will get to buy the stock at a lower price. Now the stock is moving at 80.65, so 80.4 I have placed. You can see it is pending right now. It is open. The stock is moving at 80.7. I have placed an order to buy over here. You can see the quantity, 25 quantity I bought, and right now the stock is running at 80.70. The price that I have placed is 80.40, my bid price. This is my bid price and it is still open. Now I'll show you how to place market order instead of placing limit, you can buy at market price. You just select the market price over here. So whatever price is there, I mean prevailing in the market, at that price your share will be bought. This is the first one that I took at 80.65. This is the average price at which we purchased, 80.65, and the stock is running at 80.75. 25 is a quantity. It will also show the P&L over here. It's a profit of rupees 2.5. So all the stock that you traded will come here in positions. If you're taken for a long term, then it will come under holdings. Now to place the stop loss, I'll just press exit and then place the stop loss. Now the average price is 80.65, that is the price at which I bought. I'll keep stop loss market so that slippage doesn't happen. I'll keep it at 80. Selling. Now my stop loss is placed. So in the orders you can see here, trigger pending, sell at, you can see the order is MIS at 80. So I bought at 80 right now 80.60 is a price. If it comes to 80, it will get triggered. Next, let's see how to place a sell order. Now I'll show you how to exit that transaction. You can place stop loss market. I'll just place it below the purchase cost so that quickly I can show you how to execute it. I'll place at 80.5. You can see it is placed. Now when this LTP comes to 80.5, it will get triggered. Now if you modify this, if you want to modify this, that is the order that you placed does not trigger and you want to modify it, then you can do that also. I'll modify this to 80.55. By just clicking modify button, you can change the prices. See, it got executed, complete. So now the transaction is squared off. It is so stop loss got hit at 80.55. So this is how you can execute buy and sell orders. This was just an example to show you how to do it. I just bought a small quantity so that you will understand how to execute the buy and sell orders as well as how to execute the stop loss.
I have tried to make the session as simple as possible, and yeah, there are still more deeper things to look at, but for an investor who is not from the financial background, for a simple person, these things if you keep in mind before investing, that is more than enough. That can give you tremendous results. So I hope this video was helpful for you. You can also check out my other videos on price action, on expiry trading setup, on basics of options, also on swing trades and many more in my website. So hope this was helpful for you. So let's meet again in the next session. Till then, happy trading.